Hi guys, this is Phil Town for Rule 1 Investing. We're going through the 6 market-crushing principles that we have that come to us from Warren Buffett. Basic idea is an acronym here that starts with R, radar, U, understand, L, love, E, event, and the next letter is R, which stands for reduce basis. All right, when we buy a company, we buy the stock in the company, let's say we pay $50 for the company, $50 is our basis. That's the amount of money we have in the company. Now, what we want to do is understand that the market can fluctuate rather dramatically, and we would like to get as much of our money off the table as possible and put it into new investments. And we can do that by reducing our basis with some very cool cash flow strategies like dividends, buybacks, and options or derivatives that can return our money, get it off the table quickly. So the less money that we have on the table, the lower our basis is, what we call adjusted basis, the lower our risk of being wrong is, and the higher the rate of return that we get from things like dividends and buybacks. So let me give you an example of Coca-Cola. Within 10 years, Coca-Cola's dividend will be up to $2.60, and we will only have about $12 left on the table. In other words, we own $12, we have $12 of risk in that company, and we're making $2.60. Now think about that. $2.60 per year of dividend divided by $12 of ownership left in the stock, because this dividend and buybacks and options have taken the money off the table that we originally paid. So at this point in time, 10 years down the road, we've removed as much as $20 of our own risk out of this, and we're now making a return that's roughly about 20% per year. 20% per year cash flow. You're sitting in retirement, this blue chip stock is paying you out $2.60 a share, or 20% on your invested capital. That's crazy money. And every year, that's going to get larger at about 10% per year. In other words, if we're living on this in retirement, we don't have to worry about inflation. We don't have to worry about the market coming down. I mean, Coke's at like $40. It's not going to come down to 12. We're going to pick up $2.60, and next year, we're going to get about $2.90 or so. The year after that, maybe $3.10. So every year, this goes up and up, and Coke's been doing that for like 60 years. So what you're going to do is we end up with stocks by reducing basis that produce a return here, cash on cash, that's like a bond. In fact, Warren Buffett calls this kind of thing an equity bond. And an equity bond is essentially equity, which is ownership of something, in this case Coca-Cola, that's producing a return of cash flow that comes to you that you can spend in your retirement. Reduction of basis to produce this kind of return of cash flow in retirement is nirvana. This is a secret that Buffett doesn't talk about much, but I'll give you a real quick example. He bought a company called See's Candy for $25 million. That company now produces $65 million a year of cash flow for Buffett. So that's the secret of getting rich and staying rich and getting to spend your retirement playing golf, not out there trying to watch the stock market every day. Hey, our next video is a secret ritual used by good hedge fund managers when they buy a stock or a business, and it's part of this acronym.